If you've been keeping up with the news recently, chances are you've seen the phrase stock market crash everywhere. And to be fair, it makes sense why so many people feel uneasy. Markets are hovering near record highs, valuations seem expensive, and almost every headline is warning about a major downturn. But here's what really matters, and this is what we're focusing on today. The reason people are anxious in 2026 may not be what you expect. And even more importantly, what you should actually do about it could be very different from what most people assume. Let's break it down. First, let's recognize what you're likely feeling right now. You've put in the work to build your portfolio. Maybe you've been investing throughout 2023, 2024, and 2025, watching your balance steadily increase. And now the question starts creeping in. Is this the peak? Do I cash out? Or do I stay put? That feeling of unease is completely natural. It's simply how our brains are designed to react. But here's what's really going on at the moment, and why Wall Street is paying close attention. There's a measure known as the Shiller P ratio. In simple terms, it shows how expensive the stock market is relative to corporate earnings averaged over the last 10 years. At the moment, it's hovering around 40. To give that some context, the market has only been priced higher once in the past 150 years, and that was right before the dot-com bubble collapsed in 2000. So yes, these worries aren't being pulled out of thin air, but, and this is the key point, there's a big difference between something being expensive and being on the verge of a crash. Here's what most people overlook when they focus only on valuation numbers. Back in the late 1990s, companies were priced at extreme levels, but many of them weren't actually profitable. Think about Pets.com. Remember that? They were burning through cash. The earnings simply weren't there. Today, it's a very different situation. These companies are generating massive profits. Apple, Microsoft, Google, they're not early-stage startups chasing big ideas. They produce huge earnings, real cash flow, and offer products used daily by billions of people around the world. That doesn't mean the market can't fall. It absolutely can. But why it might fall makes a huge difference in how you should respond. Another major difference is artificial intelligence. This isn't just hype anymore. It's actively being built into real businesses. I've been reading recent earnings reports, and companies are already showing measurable revenue growth and cost reductions from AI adoption. These aren't future promises. They're real results. Does that justify every stock price? No. But it does suggest this isn't the same kind of speculative mania we saw 25 years ago. Now, I'm not here to say everything is perfect and there's nothing to worry about. There are legitimate risks. First, we're dealing with the highest tariff levels since the 1930s. That's not a political opinion. It's simply reality. And tariffs tend to slow economic activity. You can already see the impact showing up in manufacturing numbers. Second, unemployment has been slowly rising. It's now at a 4-year high. Nothing disastrous yet, but the direction isn't encouraging. Third, the Federal Reserve is signaling that aggressive rate cuts are likely off the table. That matters, because lower interest rates typically help support higher stock prices. So we have elevated valuations plus some economic pressure points. That's the real issue. But this is where things get different from what most people expect. A lot of the crash forecasts you see assume that if something goes wrong, everything collapses all at once. Fast, dramatic, like 2008. But if you look back at other periods when valuations were high, that's not always what happened. In many cases, the market simply moved, sideways. Sometimes for years. No crash. Just underwhelming returns while earnings slowly caught up with prices. That's not exciting. You can't really make a scary YouTube thumbnail out of "the market might be boring for a while." But historically, that outcome happens far more often than full-blown crashes. So what should you actually do with all of this? First, don't try to perfectly time the market. I know, you've heard that before. But here's why it matters, especially right now. If you sell everything today and the market climbs another 15% before later dropping 20%, you didn't protect yourself. You actually hurt your returns. This happens to investors all the time. Second, if your portfolio is genuinely keeping you up at night, that's a signal about your asset mix. You might be holding more stocks than your personal risk tolerance can handle, and that's completely fine. There's nothing wrong with owning more bonds or cash if it helps you stay calm and invested for the long run. Just don't mistake fear for a well-thought-out plan. Third, this can be a smart moment to double-check your diversification. If your entire portfolio is packed into the Magnificent Seven tech names, it may be worth rethinking that. Not because those companies are bad, but because concentration always carries more risk than diversification. That's just math. Look, I don't have a crystal ball. I can't tell you whether the market goes up or down next month, and neither can anyone else. The experts on TV don't know either. They're just better at sounding confident. What I do know is this. Every major market downturn in history has eventually been followed by new highs. Every single one. Here's what I believe is the real takeaway from studying market history, and this part may surprise you. The investors who were hit the hardest in past crashes, whether it was 2008, the dot-com bust, or even Black Monday in 1987, weren't the ones who stayed invested through the turmoil. They were the ones who panicked and sold at the very bottom, locking in losses that could have been temporary and turning them into permanent damage. Think back to March 2009 for a moment. The market had been dropping for months. Fear was everywhere. Some investors finally hit their breaking point and sold everything right at the low. Then they had to sit and watch as friends who stayed invested recovered within a few years and went on to build even more wealth. Meanwhile, they stayed in cash, too nervous to jump back in, replaying that decision in their heads for years. Then there were investors who had taken on far more risk than they realistically should have. Maybe they were fully invested in stocks despite being only a few years from retirement. So when the market fell 40%, they actually needed that money to live on. They didn't have the option to wait for a recovery. They were forced to sell at the worst possible moment. The investors who made it through these periods not just intact but better off had three things going for them. First, they were properly diversified for their age and objectives. Not so conservative that they missed growth, but not recklessly concentrated in high-risk stocks either. Just a sensible, balanced approach. Second, and this sounds counterintuitive, they continued investing during the downturn. I know that feels uncomfortable when your account balance is shrinking, but buying stocks when they're down 30% is literally purchasing them at a discount. That's often when long-term wealth is actually created. And third, and this is the hardest part, they didn't let emotions drive their decisions based on whatever scary headline appeared that day. They didn't panic because a neighbor said the economy was finished. They didn't overhaul their strategy because someone on TV sounded confident. They stayed committed to their plan. Now, could we see a 20% pullback in 2026? Absolutely, that's possible. Could the market rise another 20% first and then correct? That's possible too. Could we move sideways for a couple of years while earnings slowly catch up to stock prices? That's also very realistic. I'm not saying this to dodge a prediction or cover every outcome. I'm saying it because that's how markets actually behave. They're unpredictable. Anyone claiming they know exactly what comes next is either selling something or fooling themselves. What you can control, what truly matters, is making sure your portfolio fits your real situation, your timeline, your genuine tolerance for risk, your actual goals for your life. Not some expert's forecast that could be completely wrong. Not what sounds exciting on social media. Not what your friend is doing. Only what genuinely makes sense for your life and your circumstances. So here's my challenge for you this week. Instead of asking, is the market going to crash? Ask yourself, if the market dropped 25% tomorrow, would I be okay? Would I be forced to sell? Or could I ride it out and maybe even invest more? If the honest answer is that you'd struggle, that's the issue to work on. Not trying to predict something that can't be predicted. Thanks for watching. If this helped quiet some of the noise in your head, do me a favor and share it with someone else who's feeling that same uncertainty. We're all learning and navigating this together. I'll see you in the next one. And remember, be smart with your money.